Can I start with a general monetary policy question? Would you now contemplate negative interest rates and buying riskier assets under QE?
Yes, I'll start. I'm sure colleagues may wish to come in, because it's obviously a question that's getting some attention. So let me start with a very general point as well, that we do not rule things out as a matter of principle. I mean, that would be, I think, a foolish thing to do. But can I then follow that up by saying that doesn't mean that we rule things in either? Actually, the MPC has a history really since the financial crisis. So obviously, really since the very sharp cuts in interest rates that happened in the financial crisis period, of keeping under periodic review the lower, so-called lower bound. And they've done that, the committee has done that several times since the financial crisis, with good reason. And I think, given what we've had to do in the last few weeks, it would be no surprise to learn that, of course, we're keeping the tools, therefore, under active review in the current situation. Now, the few things I'll mention on that. What are we doing, actually? Well, first of all, obviously, we're very keen to observe and are observing how the economy responds to the cuts that we have made, because, as you know, we've cut rates nearly to zero now, I mean, 0.1. And we're particularly keen to obviously to observe that, bearing in mind arguments that are made, and well made, actually, that the effects of cuts weaken as you get nearer to the zero bound, and could even become counterproductive. And that's one of the arguments that we have to assess, also in the context of negative rates. We also observe we're observing the effects of the measures that we can use and have used to counteract that weakness of pass-through. We implemented in March a new term funding scheme, which effectively provides medium-term funding by the Bank of England to the banks at the policy rate to reinforce the pass-through as we get down into this zone where the pass-through is weaker if we leave it to its own course, as it were. The next thing that we're doing is obviously looking very carefully at the experiences of those other central banks who have used negative rates, and a number of them are actually publishing quite interesting assessments at the moment of that. I think, if I could draw some overall messages from that, I think one is that the context in which negative rates are used is very important. That's the cyclical context. Secondly, the structure of financial systems in which they're done is important. Each country has a different structure of its system, structure of its banking system. Thirdly, I think the communication of it, were one to go near it, would be absolutely critical. I mean, this is not a thing that, naturally, I think, if you don't mind me saying so, I think members of the public would find it quite challenging to understand exactly what it is and what it isn't, because let's be clear, in countries that have used negative rates, it's quite a nuanced policy tool. It's not a straightforward policy tool. So all I just say is we're not ruling it in, but we're not ruling it out, and now is the right time to be reviewing all the tools we're using. We're obviously always reviewing the effectiveness of using quantitative easing, and as you say, we will always also review the prospects for the use of what sometimes gets called credit easing or the purchase of risky assets. Bear in mind, I mean, we did innovate there in March with the introduction of the commercial paper facility, on which we've advanced around about £20 billion now to companies. So we've got some of our own evidence, we've got evidence from other central banks, and we are doing work on all those tools, and we'll continue to do it, because we know that we may have to draw on our toolkit at any point. And obviously, as you referred to, we've had that experience of having to act very rapidly. So having the whole toolkit under review and assessed as the context changes is important.